As of this moment, SoFi Technologies, trading under the ticker SoFi, is priced at $28.85, reflecting an intraday dip of about 0.81%. Now, the immediate reaction might be to categorize this as simple market noise, a minor fluctuation in a volatile fintech sector. However, what most traders are likely overlooking today is the subtle but significant shift in institutional block trades over the last 48 hours. We're seeing an increase in dark pool activity, suggesting that large players are repositioning, not necessarily liquidating. This isn't about panic selling. It's a calculated chess move happening behind the curtain of public market data. And it hints that the street's perception of SoFi's immediate future might be far more complex than the daily chart suggests. The common expectation is that SoFi is a straightforward growth story, a neobank steadily chipping away at the market share of legacy financial institutions, a popular choice for those interested in self-investing or opening an individual brokerage account. The reality, however, is that SoFi is currently at a critical inflection point, where its success is becoming increasingly tied to macroeconomic factors it cannot control, specifically the Federal Reserve's stance on interest rates and the overall health of the consumer. The narrative of being a disruptive force is compelling, but the deeper reality is that its destiny is intertwined with the very systems it aims to disrupt. Let's dissect this tension further. The prevailing belief among many retail investors, particularly those using platforms like the Robinhood app or SoFi Invest itself, is that the company's diverse ecosystem, spanning lending, financial services, and a technology platform, creates an unassailable competitive moat. They see the synergy between student loan refinancing, personal loans, mortgages, SoFi Money, and SoFi Invest as a self-reinforcing engine for growth. They believe that once a customer enters the SoFi ecosystem for one product, they are highly likely to adopt others, driving down customer acquisition costs and increasing lifetime value. This is the story the company has expertly marketed, and to a large extent it has been true. However, the current economic climate is stress-testing this model in unprecedented ways. The reality is that the lending portion of SoFi's business, which remains its primary revenue driver, is exquisitely sensitive to interest rate fluctuations and credit quality. While the diversification into other financial services provides a buffer, a significant economic downturn could disproportionately impact its core profit center. The expectation is a smooth linear expansion. The reality is a cyclical vulnerability that the market seems to be pricing in with every tick of intraday volatility. Looking at the recent stock movement, the choppiness we're observing isn't isolated. Over the past month, SoFi has demonstrated significant momentum, but this has been accompanied by higher-than-average trading volumes on down days, a classic sign of institutional distribution. While the stock has been hitting new 52-week highs, the underlying technical indicators are showing signs of exhaustion. We're seeing a bearish divergence on the relative strength index, where the stock price is making higher highs, but the RSI is making lower highs. This suggests that the upward momentum is weakening and the stock could be due for a more substantial pullback. This is the kind of nuanced analysis that often gets lost in the simplified narratives popular on social media and even on some online investing sites. It's not just about whether SoFi is a good company, it's about whether the current stock price accurately reflects the inherent risks. When you compare the platform to more established players offering services like Schwab Intelligent Portfolios or the comprehensive wealth management services at Fidelity, you realize that SoFi is still in a high-stakes competition for the affluent customer, a demographic that is crucial for long-term profitability in the financial services sector. The success of their investment help and intelligent portfolio offerings is paramount to its evolution from a lending-focused entity to a truly diversified financial powerhouse. To understand the current context, we must briefly touch upon SoFi's origins and business model. SoFi, which stands for social finance, began with a focus on refinancing student loans for high-earning graduates. This created a niche market of creditworthy customers to whom they could then cross-sell other financial products. This strategy was brilliant and fueled their initial growth. Over time, they expanded their offerings to include personal loans, mortgages, and a suite of financial services products delivered through a sleek mobile app and online platform, directly competing with the user experience of Fidelity Investments and the Robinhood stock trading platform. They even acquired a national bank charter, which was a significant step in reducing their reliance on outside banking partners and improving their net interest margin. Past performance has been impressive, with consistent revenue growth and a rapidly expanding member base. However, past performance is not indicative of future results, a maxim that is especially true in the fast-changing fintech landscape.
The reliance on the student loan business, while a historical strength, also became a point of vulnerability during the federal student loan payment moratorium. This forced the company to accelerate its diversification efforts, which has been both costly and complex. Looking ahead, the future outlook for SoFi is a tale of two potential paths. The bullish scenario, which is the expectation of many investors, is that the company will successfully navigate the current macroeconomic headwinds. In this version of the future, interest rates stabilize, the credit quality of their loan portfolio remains strong, and the continued adoption of their financial services products drives margin expansion. The successful integration of their technology platform, Galileo, which provides infrastructure for other fintech companies, could also become a significant high-margin revenue stream. Proponents of this view would point to the powerful brand recognition SoFi has built and its ability to attract the younger demographic that is disillusioned with traditional banking. They might argue that platforms like Interactive Brokers are for a different, more professional type of trader, while SoFi and Robinhood have captured the next generation of investors. The alternate scenario, which reflects the underlying reality of the risks, is one where a prolonged period of high interest rates and a weakening economy leads to a significant increase in loan delinquencies. In this future, the growth in their financial services segment is not enough to offset the deterioration in their lending business. Competition from both legacy institutions, which are rapidly improving their digital offerings, and other fintech players could intensify, putting pressure on margins. The high valuation of SoFi stock, which trades at a significant premium to many established financial companies, could come under severe pressure if growth begins to falter. The path forward is not guaranteed. There are significant execution risks, and the company's ability to maintain its high-growth trajectory in a less favorable economic environment remains the central question for investors. The difference between the enthusiastic expectation and the sober reality will ultimately determine the long-term trajectory of the stock. It's not a simple bet on fintech disruption. It's a complex wager on economic cycles, competitive dynamics, and management's ability to execute flawlessly. As you consider your own investment strategy, whether you're using SoFi Invest, Fidelity, or another platform, it is crucial to look beyond the surface-level narrative. I'm curious to know your perspective. Comment below what percentage of your portfolio is currently allocated to fintech stocks. In summary, the story of SoFi is far more intricate than the popular narrative suggests. While the current stock price reflects a degree of optimism, the intraday volatility and underlying market mechanics point to a more cautious reality. The expectation is that of a fintech juggernaut on an unstoppable path of growth and disruption. The reality is that of a company highly sensitive to the macroeconomic environment, facing intense competition and navigating the inherent cyclicality of the lending business. The true value of SoFi will be determined not by its ability to simply attract new members, but by its ability to achieve sustainable profitability across its diverse business segments, particularly as economic conditions become more challenging. The disconnect between the simplified growth story and the complex financial reality is where both the greatest risks and the most significant opportunities lie for the discerning investor. Understanding this dynamic is the key to making an informed decision about SoFi's place in your portfolio, whether you're a seasoned trader using Interactive Brokers or a new investor exploring options on the SoFi trading platform.